an RBI policy rate hike after 4.5 years. Is this a change as far as the monetary policy trajectory is concerned, even though the RBI maintains its stance as neutral? How is North Bloc reading into this, and what is the take of some of the most senior members of Mr. Modi's government? Let's take this across to a very, very special guest who's joining us right here, the NITI Aayog Vice Chairman, Dr. Rajiv Kumar on ET Now. Thank you very much for sparing time out and speaking to us exclusively on this big day as far as the RBI policy is concerned. You had warned, sir, of an overreaction. You had said the concern is that maybe RBI will overreact. Do you believe RBI has overreacted on account of the panic due to the inflation trajectory and crude oil prices?
No, I won't call it an overreaction, Supriya, because I think the 25 basis points was widely expected, and you can see that the reflection of that is that all the interest rate sensitive sectors, like banks, real estate, automobiles, have all sort of their stocks have all moved up in response to the policy. I think the RBI was in a sort of couldn't do anything else situation, given the emerging economy's troubles, given the situation between the US and the rate hike expectations there, the sort of a little pothole in economic recovery in the euro circles. So I think RBI in its attempt, in the right attempt to stay ahead of the curve and not to see any sort of fragility coming into our macroeconomic balances, has perhaps done the right thing, as also reflected in the fact that the MPC voted 6-0 for this 25 basis points, and the hike in the petroleum prices. I think something like a $12 hike in the last few weeks probably cast the die, as it were. The die was cast with that, because the RBI can't possibly accept a rise in headline inflation. And while I had thought that the rise in core inflation could be transitory, and that food inflation has remained muted, and that might drive RBI to maintain the interest rates, I can see their nervousness in inflation in expectations getting entrenched. But but the big news for me, Supriya, is that RBI is now saying finally that the output gap has closed, and that we are expecting good investment recovery in the second half, and that means that the Indian growth story will continue despite this tightening of the monetary policy today.
But Dr. Kumar, symbolically, this is the first rate hike in 4.5 years, and it almost seems to signal the end of the accommodative stance that we've seen from the central bank. So from that point of view, as a policymaker, how worried are you about the signal that this sends, that the accommodative stance has ceased? Yes, the RBI is maintaining a neutral stance, yet it's almost a signal of an end of its accommodative position.
Yeah, for me, I think it's in some sense very good news, as I sort of hinted in my just now, which is that the first hike in 4.5 years means that economic activity is strengthening. That means that as I said, the output gap is closed, capacity utilization levels are now high, investment activity is picking up, and the RBI, in its attempt to stay ahead of the curve, is saying that look, we don't want all of this to get reflected in higher inflation. Now the issue certainly becomes that we need to now focus on any remaining supply side bottlenecks, so that so that the investment recovery can get further reinforced, and we can hike up the growth going forward. And to that extent, I think the RBI has maintained the growth GDP growth forecast at 7.4, and I personally believe that they will be surprised by the upside that this economy will show going into the second half, and that my own expectation is that we will get more than 7.5, higher than 7.5% for the whole 2018-19. So to me, this first tightening in the 4.5 years does not reflect is not really a cause of great worry, but in some sense reflects that the economic activity is perking up quite nicely.
And I think that's the view that's being shared by North Block as well. But before I go across to what the Secretary, Department of Economic Affairs is saying, and is this a position of New Delhi, I have a quick question to ask of you, because, you know, you perhaps seeing this in a more balanced way, but there are voices in Delhi that they're not very happy with a rate hike. And my question to not just you, but people at large who do not want a rate hike is that here you have an institution whose mandate is price stability, whose mandate is to rein in inflation. They do inflation targeting, and the inflation target is at 4%, whether you like it or not. It is neither 2 nor 6. With core inflation that excludes food and fuel, and you believe it's transitory, the RBI certainly sees more hardened, underlying, persistent issues with inflation. How did anybody expect the RBI not to act? If you've got core inflation at levels of 5.92%, you have an institution that's going to do inflation targeting. Were we being foolhardy to expect the RBI not to act?
Well, this is what I said, earlier, Supriya, which is that I think RBI was in a no choice situation at the moment, given what's happened to the core inflation and also the hike in petrol prices. But what I was, and I don't have the data which of course the Monetary Policy Committee must have had in terms of inflationary expectations going forward, etc. But my own thought was, and I had written about it and I sort of publicly stated it, that maybe some of the elements of the core inflation like education and health and housing prices would be very transitory, because there might have been increases at the beginning of a fiscal year. And also that the recent moderation in crude oil prices may have may have told the RBI that the oil price and price situation has stabilized, and those two will lead the RBI into sort of maintaining the rates where they were. But clearly RBI has more data than we have at this time, and given what has happened, as I said, to the core inflation and to the petroleum prices, you are quite right that RBI didn't have any choice in the matter at the moment. And I personally think that that the RBI would do well to now pronounce upon what, rather than just say that we have got a neutral stance. It would be useful for RBI to sort of spell out more clearly how they see the future evolving. Now the only exception to all of what I have said is that if in case the inflationary expectations are not strong, if in case it is clear, as some economists have said, that the CPI inflation, the core, the non-oil, non-food, non-fuel inflation is not that high, then I think the RBI would do well to make its stance not just neutral, but saying that it's that it could be accommodative in the future if oil prices stabilized and core inflation, the rise in core inflation came out to be transitory.
Dr. Kumar, one of the reasons why analysts believe the RBI has moved on rates is also because of the move that we've seen in the currency, and obviously that has an implication on inflation as well. Given the fact that the Monetary Policy Committee has voted unanimously for a rate hike, even the doves in the committee, people like Mr. Dholakia, who've been dovish over time, have now voted for a rate hike. How worried would you be that going forward into 2018, we're likely to see more rate hikes, that the probability of the next action is also likely to be one of a hike?
Yeah, as I said, I'm repeating myself. This will depend entirely on what happens to oil prices and to core inflation. If oil prices stabilized and the rise in core inflation was seen to be transitory and that stabilizes as well, then I would see there is no reason for RBI to have another hike down the road, and that is my expectation. And on the other hand, about the currency depreciation, etc., I think we have depreciated now 6% in the last 3 or 4 weeks, while our real effective exchange rate had gone up by about 21%, I think, over the last 14-15 months. So I'm not so worried about the rupee depreciation, because I think we need the one big thing that we need to do in our economic policy management is to accelerate and promote and go for much higher exports because that also is that is the way to beat some of the sort of apprehensions about the external balance and about current account deficit, etc. So, I think the RBI, as I said, if they have the data that the oil price futures look to be moderating, which I think I have seen some data which tells me that the 6-month futures for oil have moderated, and the shale oil might also make an entry. If they see that health and education price increases are not going to remain permanent, then RBI should be brave enough to say that we will not we can we will retain our rates and maybe even shift to an accommodative regime, if the growth element requires that. If in order to perk up our investments we need that, the RBI should really not consider another hike going forward.
Dr. Kumar, I mean, I'll just add my 2 bits to this. I don't think it's just going to be about oil futures. I think it will also depend on, if at all there is a government new formula on oil pricing. Much will depend on whether does that take inflation and the RBI policy stance on that. But a quick question, you mentioned investment, and obviously from a government's point of view you would want every action to be geared towards putting that virtuous cycle of investment back in motion. The RBI's own commentary, its own resolution, and the governor's own commentary in the press conference seems to indicate that there are early signs of recovery, there are early signs of investment perk up, there is also early signs of credit offtake. Do you believe this 25 basis points rate hike at all alters that picture? Does it at all dampen that sentiment at all?
No, I don't think so, Supriya. I don't think so at all, because the fact is that there are all signs that the recovery, which was as RBI says nascent, has now taken roots. The RBI itself has said that the output gap is closing. There are lots of news that in the corporate bond markets, in the NBFCs, in the IPO activity, there is private investment activity taking place. But and I think most of this one has been directed towards preventing capital flight to safety, which might happen if the US Fed raises rates as it is expected to do. So I think in that sense, given that I think Sajid Chinoy pointed this out this morning, that a lot of our foreign capital flows are into interest sensitive sectors, interest sector flows. So I think in that sense RBI might have done us a favor by hiking up this rate, so that we can continue to attract foreign capital, which is also useful for our own investment and our own and our markets. So overall, Supriya, I think this 25 basis points is not going to dampen investment activity at all. It's probably also and hopefully will not dampen the sort of retail lending, which has now become the mainstay of commercial bank lending. I refer to housing, automobiles, motorcycle, etc., those sort of loans, because it will, and hopefully, if the liquidity is quite okay, as the RBI tends to indicate, then the commercial banks will be able to absorb this rate, because they are in any case holding huge amounts of SLR, funds, and therefore they may not pass out, they may not pass on this increase, and if they don't, then even this particular segment of demand, which is of retail credit, may not get affected. So I am actually very hopeful that the 25 basis point increase will not adversely affect our growth and investment prospects.
Before we let you go, Dr. Kumar, and that is on the fiscal deficit. I know you don't obsess too much about the last decimal figure when it comes to the fiscal deficit, but there are concerns now on account of the increase in crude oil prices, the rally that we've seen there, on account of populist measures like the sugar bailout package, and the concerns over MSP revision, and how all of this could play out on the fiscal deficit for this financial year. How would you address those concerns in the market?
First, to repeat myself and what you said, I am a complete fiscal deficit agnostic. I mean, I don't believe in that number, I don't see that number as a target, and I don't think anybody else should do as well. Having said that, I should point out that we have done some exercises in the NITI Aayog which show that there is more than enough fiscal space which is available, given the buoyancy in our direct tax rates, given the expected buoyancy and expansion of the GST take. After all, we would probably be getting 1 lakh crore per month going forward, and given the non-tax revenue possibilities that we should utilize. After all, NITI Aayog has suggested 45 disinvestment proposals for the government, most of which have actually been are still waiting to be held. I think there shouldn't be a worry on the fiscal deficit side at all, because there is enough fiscal space, and the government would be able to stick to its fiscal deficit target in 2018-19.
All right. On that note, thank you very, very much for joining us with your perspective and your take as far as the RBI policy is concerned. Thanks very much, Dr. Kumar, for taking time out and being with us right here on the India Development Debate Direct. We take a quick breather. Plenty of news and updates follow right here on ET.